Today we're talking about these pesky hidden taxes for high income retirees. So if this applies to you, you're going to want to listen to this. And we're going to talk about the Medicare tax, which is IRMAA, and IRMAA stands for Income Related Monthly Adjustment Amount. So the government has these acronyms that get created that only are understood by them and professionals like me. But so today's video is not to explain IRMAA to you, the Medicare tax. We have other videos about that, and we're going to put the link to the most recent one for 2023 IRMAA right here in the video. So if you want to go back and watch that, you can learn about IRMAA specifically. And then you have the Social Security tax, which this becomes news to people that their Social Security benefits are going to be taxed, especially if they have other income or significant other income. When you put the two together, they're going to have to pay taxes on their Social Security. So that's another hidden tax. And then we have a video on that. We have several videos on that, and we're going to plug in right up here the most recent one of those. And then you have the investment income tax, which is that 3.8%, that if you have substantial investment income, just money from interest, dividends, gains on stocks, that type of thing, you're going to have to pay an extra 3.8% above certain thresholds. So all three of those hidden taxes, and what we're really talking about today is this formula that's pretty widely misunderstood. It's called modified adjusted gross income. And so what I'd like to do now is just bring Tom on, and he's going to walk us through a bit of, it's also MAGI. And I thought the MAGI were in the Bible, and I guess they still are, but that's not what we're talking about today.
Well, it is a little bit of a mystical thing that they put in the tax code, right? And so, so one of the things that's often used when calculating these different taxes is this modified adjusted gross income. And so I'll get into the specifics of that in a second. But in all of these, you start off with your gross income or adjusted gross income, which is just a number on the front of your tax return. If you look at your 1040, there is a stated line right on there that's your adjusted gross income. So that is always going to be the starting point. So you just flip out your tax return, look at what that number is, and that's where we'll start our calculations here. Now from there, they modify it. So, they can't make it easy. So they add things back into that adjusted gross income number. And where this gets really confusing is they change what they add back into it depending on what they're looking at, what they're using this calculation for. So just a quick example. So for the IRMAA, what they add back into there, and we have this on the board, is the tax exempt interest, which again is another listed item on the front of the 1040 that's mostly produced from municipal bonds that produce tax exempt interest. They add that amount back into your adjusted gross income to calculate your IRMAA. You'll see on the board there's the non-taxable Social Security. That one is not used for IRMAA purposes, but it is used for other MAGI purposes, the modified adjusted gross income. So it gets fairly confusing with this. If you have a question, reach out. We can sort of walk you through how they calculate what that is for your certain things. But it is, they modify the adjusted gross income in some way to start running all these calculations.
So what I wanted to say is that when you're trying to understand an acronym, you're usually going to start over with the word modify. And if you're going to start with the leftmost letter in the acronym and understand it this way. If you want to understand MAGI or MAGI or whatever you want to call it, you're better off starting on the right and going that direction. So most people know what income is. It's just your salary or your Social Security check or your interest earnings, or people generally know what income is. And then the first modifier is gross income. So that's income before tax deductions. So we're going to go one to the left, and we're going to say, okay, so now gross income is just that top line where you haven't taken any deductions yet. And then adjusted gross income is where that can be up or down, but mostly they're going to be adding things for your adjusted gross income. But I'm not trying to teach a school on calculating all of this. I'm just trying to get you a basic understanding. And as Tom said, you can pull this right off the tax return. And then for the seniors specifically, and the Medicare tax and the Social Security tax, the investment income tax, they had then had to modify it. They chose to modify it. The reason they did this is just back when they started taxing Social Security, they said, okay, so we're not going to tax somebody that just has Social Security. We're going to tax people on their Social Security when they have Social Security plus other income of substance. So then first you got to pay tax on that other income, but then you have to pay tax on your Social Security based on that other income. So what a lot of people did that had money is they just shifted a lot of their money into municipal bonds. So they were tax free and they didn't count in that other income. And then they're saying, oop, okay, so now we're going to come up with this modified adjusted gross income. And we're going to add those tax free municipals back on. And a lot of folks, they own these things and they all of a sudden these taxes hit them at 65 and they're coming into us trying to explain all these extra little taxes. And then we end up with MAGI. We got to give some sort of an explanation. I don't want to try to teach a school on MAGI and all the elements because it's fairly easy for us to calculate. I'm just trying to give you a sense of what's going on, and that if you start reading about in the show notes, you start reading about these like IRMAA, and then you get to MAGI. So Tom, could you bring up the show notes and you could show them what we're talking about here?
Sure. And so we have our show notes. They're a link below the video. They're also on our website. We start out with a picture of the board, but then we have some more details that go into a little more context for what's on the board. This first page really talks about the IRMAA. So this is for 2023, people on Medicare in 2023. And we have videos on this, but they look at 2 years ago tax return. We don't need to go into all the specifics on this video, but they look at your income, and then based off your income, they will charge potentially a higher amount. So you can sort of see that in the chart here based off if you're a single filer or a joint filer, what your income is, what they charge for Medicare. They don't, in this chart, they don't define real specifically the modified adjusted gross income, but they do point out that's what they're looking at for the premium. The next page just goes a little more this is, and we'll get to this a section on the board, but this goes into some ways that you can maybe reduce strategies to reduce the modified adjusted gross income now that you know that it's potentially a problem. And then the last page in the show notes is really I have a printout on my desk of this chart. I reference this all the time, but this really goes for what are the tax brackets in 2023. It talks a little bit about the net investment income tax at 3.8% here. I mean, it goes through and all some commonly used tax rates that we use a lot in our business is on this orange chart here. But again, the show notes just give a little more detail of what's on the board.
So if you really get right down to it, the biggest factor that we deal with in MAGI is this tax-free municipal bonds. So people either have them or they don't. And if you have them, you got to add them in to MAGI when you're doing IRMAA. And you also got to add them in when you're calculating your Social Security tax. And we don't do taxes. I mean, we do tax planning. And so we're going to look ahead for the whole of your retirement with a specific emphasis on the next 5 to 10 years and try to make good decisions in all 7 of these areas. And certainly one of those is taxes. And then when you get into these specific hidden taxes, surtaxes, that kind of thing, you need to have an idea of what MAGI is. And what I want to focus the rest of the time on, and I'd like to bring Tom back in because we're going to talk about what is not included in MAGI or AGI or anything, it's going to be 3 things. So I'd like to bring Tom back on to talk about those 3 items listed below there.
Yeah, and so we have these listed at the bottom of the board here, but these are things that you can use that are not going to show up on the tax return as income in any ways. And so the first one is accrued interest in annuities and life insurance. And so inside of both vehicles insurance, both insurance policies, the earnings inside them are not reportable on a tax return. In a life insurance, they're potentially never reportable. With annuities, when you pull them out of the annuity, the earnings would be potentially taxable, again, depending on if it's an IRA or non-qualified. Call us if you have questions on that. But in the current year, while it's earning that interest, it is not taxable. And so one thing that we have done with a lot of clients that have had a lot of municipal bonds producing this tax exempt interest causing issues with their Medicare premium is we've looked at transitioning some of those into MIGA, multi-year guaranteed annuity. We have other videos on those, but it's acts very much like a CD. It earns a fixed rate like a bond would, but the interest is not reportable on their tax return. The next one down that we use a lot in our planning are Roth IRAs. Roth IRAs are wonderful because the earnings in there are never taxed. It's tax-free growth for the life of the account. And so you can be really aggressive in those. I mean, you don't have to be, but any earnings inside a Roth just never shows up on a tax return, which is wonderful.
And they're not included in MAGI.
They're not, yeah, at all, which is great. And then the last one on there is traditional IRAs. So, and this is where a lot of people's money are in, and you can include 401ks and under this category. And these accounts, the taxes are deferred, so you don't have to pay taxes on the growth until you pull it out. So when you start pulling them out of the IRA, then it is included in your adjusted gross income. But before then, the earnings in the meantime is not. And so those are another account that the earnings are not reportable back on either in the adjusted gross income or they don't modify it in any way for those.
So either way, when we have somebody that comes into us and we're doing financial planning for them, we're writing a financial plan and a retirement plan. I mean, we're going to test them to see if they're MAGI, if they're a couple, are they exceeding 194,000? Are they a single person exceeding 97,000? For the Social Security tax, are they exceeding 44,000, including half their Social Security? And are they exceeding 34,000? And then with the investment income tax, it's a substantially higher threshold. But we're looking at all these things. And then, like with MAGI and with IRMAA, they're using 2 years backwards. So it just adds a whole nother layer of confusion. And we have the ability to do an appeal. But we can't appeal tax-free bonds because they're going to keep paying you going forward. And we can't appeal traditional IRA or 401k withdrawals. So, but we have an understanding of all of these and an understanding of the tax code and then how that's going to change in the future, just 3 or 4 years from now. So all of that we take into account. And then the first thing is your income needs. So we take your income needs and work backwards and just try to minimize all these taxes and get you weaving in and out of all these thresholds. That's what we do for a living. So
one last point I'll make is when we're looking at those different accounts at the bottom of the screen, the two that are probably the most favorable from a tax standpoint is going to be the Roth IRA and the life insurance, because in both of those, you potentially never pay taxes on the gains. Whereas with the annuities and the traditional IRAs, eventually someone is going to pay taxes on the gains in those. And so just something to consider and just sort of know.
Sure. So which of the 7 worries have we talked about today? Well, we've certainly talked about Social Security and tax in it. We talked about Medicare and the hidden Medicare tax. We haven't talked much about long-term care. We have talked about IRAs, 401k, and really the planning around those. We talked about income. We haven't talked much about estate planning, and the whole video has been about tax planning. So with that, I'm Hans Scheil.
And I'm Tom Griffith.
We thank you very much for listening.
Thank you.